Last night, Google's parent company posted one of the best quarters any company has ever reported. Beat on revenue, cloud growing 82%, customers lined up around the block, and the stock crashed 7%. Tesla reported a record quarter the same evening and fell as much as 14. So today, everyone with a microphone is saying the artificial intelligence bubble just cracked. I think they're reading the wrong number. Stay with me. Okay, the setup. For months, the entire market has been waiting for one moment. The first of the giant technology companies to walk into an earnings call and defend the most expensive build-out in corporate history. Data centers, chips, power. Alphabet already told investors it would spend up to $190 billion this year, and Wall Street was nervous about that number. Last night was the exam. And on the surface, Alphabet aced it. Nearly $120 billion of revenue in 3 months, up 24%. Earnings basically in line, a whisker light. The cloud business, the part that sells computing power to everyone else, grew 82%. That is not a company in trouble. That is a company printing money. And then the sell-off hit anyway. Because buried in that beautiful quarter was one line. Alphabet raised its spending plan again. Not $190 billion anymore. Up to $205 billion this year, with more coming next year. The stock dropped 7% on it. Tesla, same night, spent $5.8 billion on artificial intelligence and robotics in a single quarter, burned cash for the first time in 2 years, and got marked down double digits. This morning, the whole technology index is down more than 2%, and the victory laps have started. The bubble callers are everywhere. The spending emperor has no clothes, they say. They finally got their red day. Except, there is one number in last night's report that almost nobody on the panic side is quoting, and it happens to be the biggest number in the whole release. Because while the stock was falling, Alphabet quietly disclosed how much future business its customers have already signed up for. And that number didn't just grow, it exploded. $514 billion. That is Alphabet's cloud backlog. Actual signed contracts for future computing power that customers are legally committed to buying. And it grew by $50 billion in a single quarter. To put that in perspective, the backlog grew by roughly the value of a Fortune 50 company in 90 days. The chief financial officer said the spending increase exists for one reason: to accelerate the delivery of capacity to meet growing demand. Translation: they cannot build data centers fast enough for the customers already holding contracts. So how do both things happen at once? Record demand and a crashing stock. Here's the mechanism, in plain English. When Alphabet spends $45 billion in a quarter on construction, that money comes straight out of free cash flow, the cash the company could otherwise hand back to shareholders. Double the spending, and the cash machine investors thought they owned looks thinner, even while the business booms. So last night was not the market saying artificial intelligence is fake. It was shareholders saying, we believe in the boom, we just don't want to be the ones funding it. The market didn't reprice the buildout. It repriced who pays for it. Now follow one of those punished dollars a single step further, because this is where the asymmetry lives. Every dollar Alphabet gets fined by its shareholders for spending lands somewhere. It lands at a chip maker as an order, at a memory manufacturer as a contract, at a power developer as a 20-year purchase agreement, at a construction firm as a data center. The same capital spending that compresses Alphabet's free cash flow shows up as revenue and earnings on the other side of the transaction. And the $514 billion backlog tells you those dollars keep flowing, under contract, regardless of how the stock market feels about it. The trade is splitting in two. The companies writing the checks get marked down. The companies cashing them keep the earnings. Now let me argue against myself, because this desk grades its own work. 3 honest outs. 1. Nobody outside the company knows the profit margin on that backlog. $500 billion in contracts at thin margins is a much worse business than it sounds. 2. Rates. The 10-year Treasury yields about 4.66%. Oil just crossed $100, and if inflation forces yields higher, everything gets derated, suppliers included, and this whole framework drowns in the tide. And 3. The history rhyme cuts both ways. In the telecom buildout at the turn of the century, demand was also real. Traffic really did grow for 20 years, and the overbuilders still got wrecked before the payoff arrived. Being right about the boom and wrong about the sequence is still being wrong. Respect that. So here's my call, on the record so you can hold me to it. If this really is a repricing of the funders and not a collapse of the boom, then the suppliers should hold up better than the spenders. Specifically, over the next 5 trading sessions, through July 30th, the semiconductor complex outperforms the giant spenders. If the chip stocks fall harder than the companies buying their chips, I'm wrong. This was a genuine demand scare, and I'll say so right here. First evidence arrives tonight when Intel reports. Watch that print like a hawk. Here's what I'd take away. Alphabet's customers just signed up for $514 billion of its future. Alphabet's shareholders just fined it for building the capacity to deliver it. One of those two groups is wrong about the next 5 years, and they cannot both be. Everything else, the $100 oil, the crypto bills deadline tomorrow, the Federal Reserve next week is in Earl's full daily brief on the channel. I'm Frankie, the asymmetric signal, one contrarian read a day. Subscribe.